Good afternoon. My name is Nicole Smith and I'm the Governor of Waikato Diocesan's Monetary Policy team. Joining me today is Georgia Sweet, Sophie Wilson, Hannah Fielding and Natasha Clark. As a group, our decision is to hold the OCR at 2.5%. Today, we will touch on key factors that have influenced our decision. These include global economic uncertainty, the high exchange rate, low commodity prices, low forecast inflationary pressures, an increase in savings attitude resulting in weak GDP growth.
International. The United States is still slowly emerging from the recession with a growth rate of 1.9%. In Europe and UK, business and consumer confidence are low due to the continuation of relatively high unemployment as well as financial unrest in Europe. Asian economies remain stagnant, leading China to cut their lending rates to stimulate growth. Whilst Australia has one of the strongest economies in the developed world with a growth rate of 2.3% in the last quarter of 2011, it appears this may reduce, especially in the non-resource sector, as the recent decrease in the OCR from 4.25% to 3.5% shows concern throughout the economy. The Europe recession will be longer lasting than previously thought. If Europe deteriorates further, it will further slow the recovery of world economies. As Europe is such a large global market, weaker growth would have a huge impact on larger economies such as some of New Zealand's key trading partners, like the Asian economies. Following on, this will impact growth in New Zealand, as key trading partners, like China, will purchase fewer New Zealand goods, leading to decreased output. A careful eye must also be kept on European banks, as failures amongst them may cause international funding markets to increase.
The exchange rate. The New Zealand dollar is still inflated but has recently fallen below the 80 cents US. We predict that in the medium term it will fall another few cents into the mid-70s before stabilising due to weak export prices and slowed global growth. Commodity prices. Dairy makes up 27% of export earnings, having a large impact on the economy. Dairy commodity prices are at a 3-year low due to excess supply causing poor growth in rural economies. However, commodity prices are expected to increase in the next 6 to 12 months. Currently, USA is experiencing a severe drought, limiting food supply and therefore pushing up world food prices due to the shortage. Therefore, we can expect commodity prices to increase. Inflation. Headline inflation is contained in the economy within the policy target agreement of 1 to 3%. Rising house prices and pressures on demand for the Canterbury rebuild are a possible concern, but the low interest rates and high exchange rate will soften the impact. Globally, there is excess production capacity, therefore any increases are likely to have little inflationary pressure, resulting in low imported inflation for New Zealand. Business confidence. A rise in business confidence was evident in the first few months of 2012, increasing to 35.8 in April before falling back to 27.1 in May. These fluctuations are expected to continue over the next year as businesses react to uncertainty in the domestic and international markets.
Business investment is also more positive in the first few months of 2012, at the highest rate since 2005. Interest rates are low, so it is more affordable for firms to invest. However, since GDP growth is still slow, they may be cautious. The continuation of the Christchurch rebuild encourages investment as firms look to rebuild their businesses. Uncertainty remains due to the delay in insurance payments and critical decisions around the rebuild. Unemployment. There has been a 0.3% increase in the unemployment rate to 6.7% due to increased numbers of people seeking work in the March 2012 quarter. Canterbury Region's unemployment has decreased by approximately 3,800 to cover work in the construction industry. Unemployment is expected to decrease in the forthcoming years to 4.7% by 2016, indicating future growth to be likely. Consumer confidence. There has been an increase in consumer confidence in April from 110.2 to 114. However, there needs to be more successive monthly increases to actually state that it is improving. Increased consumer confidence suggests that our economy is building cautiously. Savings. As GDP growth slowly rises in 2013, household incomes will increase. The significant shift in savings attitude has resulted in a 47% increase in savings from 2010. This is expected to further improve, which will cause further falls in the debt-to-income ratio. Housing prices. Decreased housing values in the March 2012 quarter look to be only a temporary blip as nationwide housing prices continue rising slowly, at the highest price since 2007. Increased confidence in the property market and relatively low interest rates are a contributing factor, but many are still cautious due to high mortgagee sales in many regions.
GDP growth. There has been slight growth in the first quarter of 2012 of 0.8% due to the positive impacts of the Rugby World Cup and the Canterbury rebuild. Growth is expected to increase in 2013 and 2014 as the economy recovers and Canterbury gathers momentum. New Zealand is developing a two-speed economy, with Christchurch growing faster than the remainder of New Zealand due to increased employment with the rebuild. There are likely to be some trickle-down effects to the remainder of the New Zealand economy. The government's zero budget is aiming to return New Zealand to surplus by 2014 and 2015, but will have a neutral impact on growth and inflation. Output gap. As can be seen in the trend on the graph, the economy has cautiously entered the recovery stage of the trade cycle and is building slowly. However, there remains spare capacity within the economy, allowing growth without inflicting too much inflation. Balance of payments. New Zealand's current account is negative 5.7% of GDP and is set to increase over the next 4 years. Current expansion of firms, especially in Christchurch, will lead to greater export earning capacity in the medium to long term.
The recent influences on the New Zealand economy and the effects of overseas distressed markets, in 2012 both aggregate demand and aggregate supply are expected to rise slowly. A number of factors such as the Canterbury construction industry, low interest rates and slowly increasing consumer confidence are expected to have a positive effect on aggregate demand. Growth is hindered due to relatively high unemployment, which discourages consumption spending, 3-year low dairy prices decreasing regional spending, an increase in savings attitude decreasing consumption, and the high exchange rate which is falling but still inflated could possibly decrease net exports. Likewise, aggregate supply is expected to slowly increase or stay flat. The high New Zealand dollar causes lowered costs of production for imported raw materials. Business confidence is beginning to gradually improve, but is still fluctuating, which could possibly result in a small increase in aggregate supply. International markets are expected to continue their slow growth, therefore are less likely to import, so world markets for New Zealand goods remain subdued. Overall weak international conditions are expected to counterbalance slowly improving domestic conditions, causing weak or no growth in aggregate supply. The recent minimum wage increase is also likely to decrease aggregate supply due to an increased cost of production for firms. The output gap will remain constant with some spare capacity, but as growth is slow, there will be little inflationary pressures. The global markets are holding off on any financial decisions until after the initial acceptance of the Spain aid package and how successfully Greece implements the debt management program. As neither aggregate demand or aggregate supply are expected to change significantly over the next 18 months, we expect inflation will be maintained in the policy target agreement of 1 to 3% and see no need to change the OCR at this time. It is necessary to be reactive to situations in Europe, and if conditions change, we may need to adjust the OCR in response. With the current economic conditions, we feel the decision we have made is appropriate for this time. Thank you.
Thank you for your presentation. So now we'll move on to the questions and answers part of the day. Similar to what we had in the regional finals, where what we want is we'll ask you a question, and if you could discuss it amongst yourselves loud enough so that we can hear, and if someone can summarise that and bring it back would be good. The only difference here is we got 20 minutes instead of 10. Okay, so the first question, what are the implications if the government doesn't reach its target surplus in 2014-2015?
Okay. So the government's target surplus is to be running a surplus, so increased revenue rather than spending. The implications of this.
Well, it's already likely it's not going to be reaching the surplus by 2014-2015 because
Increased unemployment.
Unemployment's not likely to be decreasing anytime soon.
They're going to be collecting less tax from employed people, and also consumption will decrease, so less GST, and they'll be spending more on welfare payments.
So implications maybe that they're going to have to keep spending to keep stimulating the economy. They're going to be having to keep paying these unemployment benefits. And
further running a deficit.
Further debt and then further interest payment.
So this may may have to continually have a zero budget to try and return to surplus later on.
And so we might not get as strong growth further, but we might not be getting strong growth in 2015.
Okay.
The implications of the government not reaching their surplus. The surplus means they've got more revenue than they're spending, but this isn't likely to happen because unemployment has increased. So they'll be collecting less tax from employed people, income tax, and there will be decreased consumption because they will have less income, so less GST will be collected, and they have to pay more benefits, welfare payments to the unemployed people. So there's not likely to be strong growth in 2015.
Thanks.
I'm interested in your comment about the unemployment rate likely to hold up for a while. Can you expand on that a little bit more?
In Canterbury, they're developing a two-speed labour market because there's high demand there, but
Construction workers.
There's high demand for construction workers, but that's only one area,
one area
and
of the
there's
economy.
still unemployment in other areas that are still, because Canterbury's growing slower than expected.
Due to the delayed insurance payouts.
Oh yeah.
And so there's not employment in some industries, and
So the delayed insurance payout.
But due to the large need for construction industry,
So
this will significantly stabilise the unemployment level.
They can't get workers to do it yet.
Yeah.
So
But then once these come through, we'll expect that unemployment will decrease and then further head to the 4.7% expected.
There's also increase in net migration at the moment, and so this could be contributing to the increased
Labour market size.
increased unemployment rate,
Yeah.
and also the fact that there's still very low confidence firms, so firms aren't employing like they were hoped to be.
But it is beginning to improve, so this will.
yeah, it's been done.
Okay. So why unemployment is
Is likely to stay.
increasing or likely to stay around as it should be is that Christchurch is actually running a two-speed labour market. There's employment in some industries like the construction industries, but there isn't employment in other industries. This may be because of the delay in the insurance payouts, and so firms aren't getting back on their feet and they aren't employing. And so that's keeping the unemployment high. There's also an increase in net migration coming into New Zealand, and so that's decreasing the amount of jobs and increasing the amount of people unemployed. There's because of the global financial crisis, there is low business confidence in New Zealand at the moment, and firms aren't starting to employ workers. as it was hoped they should be, and so unemployment is staying high. But hopefully in the future this will go down, like in a few years, as Christchurch begins to get back on its feet, the rebuild continues, firms start employing more staff, and New Zealand gets more confident. We'll increase our investment and start to employ more people.
Why does the Reserve Bank target inflation and not other things like growth or exports? And with that thought in mind, do you think it wise or foolish if the Reserve Bank's mandate was changed?
Sorry?
The Reserve Bank's mandate for targeting inflation.
Okay.
Not just the PTA, its mandate.
It's target, yeah.
Yeah.
Okay.
Should it do something different than it currently does?
Okay.
Target on growth or something like that.
They target inflation because that has an effect on other things like growth and
money supply within the economy, and also inflation is dangerous tool in the economy because you could get deflation, which causes a price wage spiral, or if inflation is too high, this could result in money eroding and losing its value.
Inflation is a key factor in the economy, like with someone needs to be in charge of controlling the inflation.
Otherwise money will lose value.
Otherwise
Stability.
money will lose value. We need to make sure that price stability remains, so that there isn't price wage spirals and there isn't impacts on our exports.
And when there's price stability, that means it allows sustainable growth within the economy.
Yeah, since it's been implemented, growth's been more steady.
So we think, do we think it's important that
Change it.
Reserve Bank
Controls inflation. Well, because when you have growth, you tend to have inflation, so it's kind of somewhat stopping a lot of growth. But then, when you do have inflation because of growth, it could be dangerous.
So some management kind of person
Some management, but I
has to,
feel like there could be a little bit more,
inflation.
a little bit more management over growth as well.
Yeah, but inflation's still
A
important
main
to
target, yeah.
so when they set the OCR, they could kind of feel how this would impact on growth.
Well, you couldn't even be you could use another way, not just the OCR.
Yeah, and so otherwise, and
Shall we?
important to keep it between 1.
Yeah, 100%.
With inflation being controlled by the Reserve Bank, as it is the main target to keep it within 1 and 3%, we think this is quite an important thing for Reserve Bank to control, because you could get deflation, which is very dangerous for the economy, where you could end up in potentially a price wage spiral, and also as inflation increases, savings and money erodes, so it loses value. And you need price stability within the economy to have sustainable growth
And keep our exports
competitive. However, there could be more control over growth, because when the economy grows, there is an increase in inflation. But this is only if it's not to do with productivity. So if you increase productivity, this could increase growth without causing inflation. But we feel that inflation is an important tool for the Reserve Bank to control, but there could be some more control over growth.
Okay, thank you. Now, you did mention in the policy targets agreement that we have a target for inflation of between 1 and 3. Why 1 and 3?
Below 1%, there's
We've
risk of
faced the
deflation.
possible risk of deflation, which is very dangerous because people won't be spending. They'll wait to spend because they know prices are going to decrease. Yeah, and then
that could lead to decreased increased unemployment, and could lead to recession.
So further downward,
further
which
downward
is
spiral.
hard to control and stop.
And then they want to
inflation.
make sure that inflation doesn't go above the target, because
makes it unpredictable for businesses to
Makes it
know
harder
what
to
Plan into
the
the future.
Makes it harder for firms to plan for the future, to invest.
The
It
cost
also-
of living increases, so people demand higher wages,
Yeah,
and that leads to cost push inflation.
price wage as well.
Yeah.
And our
money erodes, yeah.
the money and savings erode, and our exports, if it's above 3%, will become less competitive on the world market, and so that will lead to decreased net exports and possibly unemployment in the exports industry.
Price stability to remain.
so want price stability to keep it neutral and then sustain growth.
Yeah.
Okay, the Reserve Bank has a policy target agreement of keeping inflation between 1 and 3% in the economy. If inflation goes below 1%, we have the risk of having deflation as people wait to spend as they think that products will become cheaper. This will increase unemployment, and deflation has proven to be hard to control in the economy as it's a downward spiral that keeps going. We don't want inflation above 3% as it's hard for businesses to plan for the future. They won't know what interest rates are going to do and what their profit and goods will be worth. Cost of living will increase, so people will have a price wage spiral to keep up with the increasing prices, and our exports will become less competitive on an international market, and so less net exports, and so we want the price stability between 1 and 3% as it sustains growth in the economy.
Okay, thank you. Another question. So the Reserve Bank gets to decide on the official cash rate. Why is it the Reserve Bank and not the Prime Minister or the Minister of Finance?
Well, the Reserve Bank's primary objective is to control inflation in this PTA.
And it was in the 1980s when the Minister of Finance was in control
Of the
of
OCR.
the OCR. Or would it have been the OCR back then? Well,
No, not the
No.
OCR, but inflation.
but inflation. So, and then when this happened, he
It's harder to
mucked it up big time.
too
And
hard to control.
interest rates were at like
Yeah.
20%.
It's good to have someone like independent, so
Yeah.
then there's two different sides too.
Yeah, and they stay away from the
And there's
political
no
side.
bias kind of opinion.
Makes it more.
And he would have been looking at the whole economy, the growth and the exports and the exchange rate, whereas it's important to just have one sector focusing on just inflation, because inflation. So why the Reserve Bank is in charge of controlling inflation? The Reserve Bank's primary objective is to control inflation between 1 and 3%. It's important to have just one sector be independent to control inflation, as in the 1980s when we did have the Minister of Finance who was in charge of just the economy, he was focusing on things like growth and exchange rates and exports, and this was not just focusing on inflation, and inflation is damaging to the economy, so we need to have one person focusing on that.
Okay, thank you.
Okay, how does investment affect the output gap?
If there's more investment, increases the
It increases our
Productive.
potential GDP because we're able to produce more in the future.
Yeah.
So
Investment.
I suppose that
The
makes
amount of
that-
investment affects where we are kind of on the trade cycle.
So I would with more
So,
with more inflation, more investment, then we'll move the recovery into the boom. So we're going to be close to that.
but
gap.
investment
Yeah.
is part of aggregate demand. So,
Yeah.
when investment increases, aggregate demand increases, so the output gap becomes smaller.
Yeah.
And
Yeah.
And investment is the purchase of new capital goods, and so when we increase our capital goods, we are there's new resources, opportunity to grow.
could that decrease increase productivity.
Yeah,
'cause of
increasing productivity and
that will increase aggregate supply and have a
increase
non-inflationary.
employment.
What if there's increased investment and an increase in real GDP? That will close the output gap more.
Yeah.
It will bring it closer to potential GDP instead of being a negative output gap.
Okay. No problem.
Investment affects the output gap because as investment increases, potential GDP increases, and this also causes an increase in capital goods as there are new resources and opportunity to grow. And as investment increases, aggregate demand increases, so it shifts to the right, so the output gap, there is a smaller output gap,
Yep.
and yeah. Thank you.
Okay. So recently banks have been competing amongst themselves and you've had retail mortgage rates which are a little bit lower. Does this concern you? How would it affect your OCR decision?
Well, interest rates, does it push it higher when they're competing?
Well, the retail mortgage
No, they're going to be
lower.
lower.
They're
They're
going to be
gonna
lower.
So
So we compete for domestic.
So people are going to
So you may not.
houses and
so when banks are competing, the mortgage rates are going to go lower,
yeah.
and so
Because they want more people to come.
And
invest
because
with them.
there are now around 65 to 70% of mortgage rates are floating.
Yeah. So if interest rates are lower already, you wouldn't want to lower the OCR because that would further lower interest rates and that
Yeah.
could lead to increased house prices even more.
Yeah, further.
lower mortgage rates are going to result in increased spending as people pay off their principals,
Yeah.
and so we don't. How does that affect the OCR? We don't.
Yeah, there'll be more growth.
I don't think we'd
So
want to change it.
We
They're
won't
paying off their
want-
principal, so
yeah.
they're
no,
not less
you
debt.
won't want to change
So we
it.
won't want to change the
Yeah.
OCR because if
It's
it
gonna affect growth.
increases, it's going to decrease spending again. People won't be paying
And
off their
yeah.
principals.
And that slows down the recovery phase we're in.
Yeah.
And then if we decrease the OCR, the interest rates are even
Lower.
lower.
And it just causes higher housing
Inflation.
prices.
And we're already at a
and
historical low with the
increases in-
OCR, so I don't.
It might not have as much effect because the savings change.
Yeah.
So people are saving
Increasing.
anyway because of uncertainty. So that would like counterbalance it.
With the competition between banks, retail mortgage rates and interest rates are going down. 65 to 70% of mortgage rates are floating at the moment, and so it's easier for people to switch banks, and so that creates the competition between them. We wouldn't lower the OCR because the lower interest rates are already, with the competition, already affect consumption and investment in the economy, and the lower OCR could further lower them, and this would lead to increasing the housing prices even more. At the moment, with the low interest rates, people can pay off their principal faster, so they'll have less debt, and so we wouldn't change the OCR because it would, or we wouldn't increase the OCR because it would slow our recovery. People would save even more because there's lots of saving at the moment. We'd just leave the OCR as it is.
Very quick one. So I noticed in your presentation all the key factors you had were relatively weak factors. What would it take for you to recommend an interest rate cut? What else would have to happen?
Okay, well, for an interest rate cut, an OCR cut, yeah, Europe would have to fail.
Failed the bank.
Europe
Europe
banks
may have to default, and
that would cause the terms of trade.
Yeah.
terms of trade to
To fall.
decrease, our commodity prices would fall, decreasing net exports, and this would lead to a depreciation of the New Zealand dollar, decreased growth, and that may put us back into a recession. Then we may need to think about lowering the OCR to try and kickstart our economy again and get out of the recession.
That's all we've got time for. Someone can summarise what you've got.
Do you want us to summarise?
I'll do it. Okay. So, for the OCR to be cut, the banks would have to fail in Europe. This would cause our terms of trade to fall as net exports fall, and the New Zealand dollar would depreciate. So therefore, there'll be a decrease in growth, and would have to lower the OCR to stop the recession from getting worse. So, and to get the economy running again to stimulate growth.
Okay, thank you very much. You relax now.
Yeah, well done.